That's because some sources of risk affect all stocks. A bad jobs report will hurt IBM, Coca-Cola, and just about every other stock imaginable. Economists call this kind of risk systematic risk because it's in the system. If you want to hold stocks, then you're going to take on systematic risk. The other kind of risk is unsystematic risk. That's the risk that's unique to a specific stock. If Coca-Cola lands the contract to supply soft drinks to Regal Cinemas, then that's good news for Coke shareholders, but it won't affect IBM. If IBM develops a better way to manage energy consumption for a manufacturer, then that's good for IBM shareholders in the manufacturer, but it won't sell any extra soft drinks. Diversification gets rid of the unsystematic risk because the events that affect just one or two companies are likely to be canceled out by events happening at other companies. If you hold a well-diversified portfolio, then you're holding just the systematic risk. You might think that companies in the same line of business tend to move together more than companies in different industries. You're right. Home Depot is closer to Lowe's than it is to Apple or ExxonMobil. If you're holding only two stocks, then you're better off pairing Home Depot with something other than another home improvement store. U.S. equities are only about a third of total world equities. Can diversification help? The answer is yes, but only to a point. Studies show that the benefits of international diversification won't insulate you from major financial crises. In particular, just about every reasonably good-sized stock market around the world suffered during the crashes of October 1987 and the last 4 months of 2008. This suggests that international diversification may not offer that much extra protection. One study found that one emerging market index was almost perfectly correlated with the S&P 500 index in the U.S. They moved almost in lockstep. That's the exception rather than the rule, but it does illustrate that getting international risk exposure doesn't necessarily increase your portfolio's diversification. Still, although the benefits from international diversification are often overstated, they are real. International investing does bring complications. You'll face exchange rate risk. If your foreign company earns Mexican pesos, for example, then you run the risk that those pesos won't buy many dollars when you collect them. You'll face political risk. Investors in Iran didn't have a happy time during the unrest that led to the exile of the Shah in January 1979 and the ascension of Hugo Chavez in Venezuela in 1999 was no fun for investors there either. International investors also face information problems tracing to different accounting procedures and regulations, plus restrictions on repatriating cash, getting the money back to the U.S. Despite these problems, you may want to invest in a foreign company, such as Banco Santander, the huge international bank based in Spain. We've seen that can be a hassle. One partial solution is to hold American Depository Receipts, or ADRs for short. A U.S. financial institution buys the shares, then issues claims against them. As far as Banco Santander is concerned, you're not an owner. The financial institution sponsoring the ADR program is the owner. Banco Santander pays the dividends to that institution, which sends them on to you, the ADR holder. These ADRs trade publicly on a U.S. stock exchange, and they're priced in U.S. dollars, so you can get in and out of ADRs quickly and easily. ADRs carry extra fees of a few cents per ADR annually to cover the sponsoring institution's costs. You can also get international risk exposure and diversification through international mutual funds and exchange-traded funds. We'll discuss these asset classes more in Lesson 13, so you might want to keep this in mind. Just about all of the major financial services providers offer at least one international fund. Let's return to how we began this lesson. We asked the investment advisor's favorite question: do you want to eat well or do you want to sleep well? Only you know how well you want to eat compared to